Hello and welcome, everybody. Thank you for joining us today for our webinar on second wind markets, strategies for savvy investors. I'm Tim Graham of hotspotting.com.au, and we've got a fantastic session lined up for you today. Over the next 45 minutes, we'll explore how certain property markets, which saw strong growth in the COVID years and then either paused or corrected, are now gearing up for another wave of capital growth, or, in our words, a second wind. Think of these markets like a seasoned athlete running a marathon. After an initial big burst of energy to power to the head of the pack, they slow down to catch their breath. But just when you think they're losing steam, they find their second wind, gathering strength and momentum for another strong push. Similarly, these property markets are poised to surge again, and today we'll show you how to identify them and how to time your investments to ride the next wave of growth. Joining me today is a special guest, Zen Christofi of Reventon. With 20 years of experience, Zen will be helping talk to us about how he's been helping investors grow their portfolios over the last 20 years, and he'll help share some expert insights into a couple of these second wind markets that his team have actively been pursuing. So we're looking for a 45-minute session with about 15 minutes worth of Q&A at the end. You're more than welcome to ask questions along the way. Just poke it into the Q&A section on Zoom, or if you are watching on Facebook Live, feel free to make comments on there. We'll try to get to as many questions at the end as possible. And lastly, if you stick around to the end, we've also got some exciting free giveaways for our attendees, so make sure you stick around. With all the housekeeping out of the way, Zen, it's time to get back into it. Welcome back to the webinar. Great to have you.
Thanks, Tim. Appreciate the time and looking forward to sharing some insights with our viewers today.
That's all right. So, look, I can't believe it's October. How's 2024 been so far?
2024 has been shaping up as a fantastic year. I think the stabilisation of rates, a bit of uncertainty that we may have faced over the course of the last 18 to 24 months. Confidence is coming back into the market. We see investor activity picking up. And it's just been a stellar year for us here at Reventon, and in all departments: finance, property management. We've had some great wins, some great success stories for our clients, and we're really looking forward to finishing off the calendar year as strong as we possibly can, and helping as many more investors as we can throughout the course of this year as well.
Terrific. And spring selling season's upon us. I mean, all the big data companies are claiming that their listings are up, but I don't know about you guys. We're just not seeing it. It's a lot of these markets that we've been looking at, the listings are still very low, slim pickings.
I think again, there's always two sides to every story, and understanding that there's different pockets, and some listings may be up in certain areas, but I certainly feel that in those areas where we are seeing some great demand, there is a scarcity of listings, and it really forces investors to have a look at where is the next spot, what's the next location, where are areas that are going to see those sort of second wins, and really diving into getting that sort of data, that research, understanding it, and making informed decisions. Clearance rates are quite good, but it's this time of year. This time of year, we're always seeing listings up, so it's nothing that's unusual. And as you said, Tim, if you've been doing this for long enough, you understand that there's always going to be trends through certain seasons of the year, and we're just seeing a repeat of what generally happens in the spring season.
That's it. All right, well, to get into the topic for today of second wind markets, strategies for investors, we're going to do our format a little bit different today. So at the start of the session, I'm going to be talking about some trends that we're sort of picking up at Hotspotting, really digging into the data a bit more. And then Zen's going to jump in towards the end and actually have a deep dive into some of these second wind markets specifically, so you can understand what's driving these markets and obviously some opportunities that you could take advantage of. So without further ado, let's talk about the agenda for today. We're going to start by talking about an introduction to second wind markets. What are they and how can you take advantage of them? We're going to look at the key indicators to look for to identify these markets, the economic factors behind second wind markets, and then, of course, as I mentioned, Zen at the end will take us through a few case studies on locations. So what are second wind markets? Well, markets that experience rapid growth throughout those COVID years of 2020 to 2022, but then they've had a pause or a correction phase. They're now poised for a second wave of capital growth. Why does it matter? Well, if you understand that markets are cyclical and you can time these markets by using data and insights, then you can really take advantage and buy at the right time and really ride that next wave of growth. So before we really jump into the actual second wind markets themselves, let's take a look back over the last 4.5 years since COVID hit. So if we look at the national market, it has grown by, on average, 40% for dwellings. Okay, so what that really means, 4.5 years ago, if you owned or bought an investment property for $500,000, there's a very good chance that it's worth $700,000 today. Capital cities average 35%, and the regions average 54%. When we break up these jurisdictions, we typically say that there's 15 jurisdictions across Australia with your 8 capital cities and the 7 regional markets. And of those 15 markets, as you can see on the right-hand side there, 6 of the top 9 were actually regional markets, so outperforming the capitals. Regional Queensland led the way, 66.5%, followed very closely behind by regional South Australia, 66.2%, Adelaide 64%, Brisbane 63.1%, Perth 57.3%, Sydney down in 12th position at 34.7%, and Melbourne all the way down in 14th position at 17.2%. Obviously, Melbourne and Victoria will be a topic we touch on a little bit later, Zen.
Yeah, sure. And I think what we're looking at as well, Tim, when you're looking at those numbers, seeing the overspill of people moving into those regional markets, there's a lot of internal and external migration moving into the major cities, and there's generally an overspill. And you may see that will play a factor in rising percentages in certain regions as well. Affordability to the population's overspill.
Absolutely. And look, something, I think the media's reported on for years since COVID is that we saw all of these families moving out of the capital cities into the regions. And, COVID was the blame for that. But we've been calling it the exodus to affordability for many years, seeing a lot of people opting to live in the regional lifestyle, and also the affordability factor that's driving them there as well. So it's not really a COVID thing. It has continued post-COVID, and we believe that we'll continue to see that occur for many years to come. So the next thing we're going to talk about is the property clock. Where does the second wind market actually sit on the property clock, and why is the property clock even important? So as you can see on the left-hand side of the property clock, that's really where we want to be buying. That starts from a recovery, then it goes up to rising market, approaching the peak, and then the peak of the market. On the right-hand side, it's where the market starts to decline and approaching the bottom. We've got on both sides of the clock considerations, though, right? Pros and cons, and obviously most of them are on the pros when we want to be going up, but there's actually some pros and cons on each. So when we think about the approaching peak and the peak of the market, we typically see that there's more competition in these markets, okay, because it's very, very hot. People are talking about it at the barbecue. This is the Perth market right now. Agents are typically unreliable in these markets as well. They've got that many calls. They're really after who's going to give me the quickest and cleanest deal, and it's hard to get them to even call you back. We often see fewer deals under market value because the market's hot. It can take longer to purchase for the exact same reasons. You will potentially get faster growth if you are buying well because the market is moving quickly. And it does also mean that when you're renting, you're typically going to get at least much faster. On the other side of the spectrum, where we're looking at the start of recovery in rising markets, you have less competition. Agents are more responsive because the market isn't as hot. We have more listings to choose from. You'll find deals faster. The growth may not be immediate, but let's face it, we're not speculators here. We're investors in real estate that are going to be buying for a long-term hold. So don't get too weighed up on, I need to have growth in the first 12 months. Take your time. If you buy into this market, you'll likely be saving a lot of money because you're buying at or below market value. And of course, we do need to consider in some of these markets that if the vacancy rates are slightly higher, it may take a little bit longer to lease. So something I get asked all the time, Zen, I'm curious to know what your thoughts are. People often ask me, why don't I buy at the bottom of the market?
Great question, Tim. And I suppose something to consider. What we can't understand, and I suppose for our viewers, is how long will that cycle be at the bottom of the market for? So is it something that will continue for a 12-month period? Is it something that's for a 24 months, 3 years? We're not 100% sure about that, and there's some leading indicators to suggest what is going to take a property from the bottom of the market before we see the start of recovery. So really, I think uncertainty, purchasing at the bottom of the market, very difficult to predict when those conditions are going to change. So investing in property is obviously a long-term play, but understanding that if we can see some short-term gain, that is going to help us reinvest and get back into the market. Understanding when that bottom of the market cycle will change, I think is really important. And just looking at a couple of key indicators to see, and we'll go through them as we're going through the presentation, but just some key indicators to say, okay, 2 or 3 of these metrics are starting to change. And if 2 or 3 of these metrics are starting to change, more than likely, we are going to start having a correction. So we're going to see that change to the start of recovery sooner rather than later.
Yeah, I think that's a really good point. All right, so key indicators for second wind markets. So we're really looking for markets that have paused, but not necessarily dropped significantly. If you see markets that have dropped significantly, there's generally a reason why. And I would say what we're really looking for is more of those ones that have paused and corrected more than fell. There are a couple of markets around Australia where we did see some steep falls. A lot of them were coastal markets that probably overshot the mark during COVID. And now they're starting to get ground again. But it is important to make sure that when we're looking at these markets, we're understanding why there was such a significant drop. The other thing we need to look for is tightening supply and rising demand, because that's going to signal that the market is ready for growth again. And we also need to be looking at ongoing or new developments that support long-term growth. So are they building new road, rail, new hospitals? We're always looking for infrastructure that's going to be making that location more desirable for both homeowners and investors. Population growth is obviously a really big indicator here as well. So Australia's population growth remains really strong, with immigration and local population increasing. That fuels demand in these key markets. The impact of that on second wind markets is that we have high population growth in urban and regional hubs, increasing pressure on housing supply, which puts upward pressure on prices. So obviously, we've seen we're in a high interest rate environment now. We've seen rate rise after rate rise since March 2021. But what we're starting to see now is a stabilisation there, Zen. So after a period of these rising rates, consumer sentiment is now positive, and all major banks are tipping rate cuts by latest May 2025. And the next slide, we'll talk about what each of the major 4 have predicted. But each of them combined have said that the latest we would expect to see some rate cuts would be May 2025 at the latest. The impact on that is obviously with lower rates is becomes more affordable to have investment properties, but more importantly, it also increases borrowing capacity, which has been a real challenge for people. And you guys have got a finance department and quite a big team there. It's been a really challenging thing for investors to be able to get borrowings again in recent times.
I think coming off that COVID cycle and seeing rates so low, seeing them move up dramatically over the course of that sort of 2 years post-COVID has really shocked consumers and really made them think about, okay, affordability, the rise of household goods, electricity, gas, water, all of those utilities that have continued to rise have put increased pressure on households' disposable income. And we've seen borrowing capacities change by 20 to 30% and maybe price some people out of the market. We are seeing, as I said, some stability now, which has forced those people that were sort of looking and sitting on the fence to say, okay, we've now seen some stability over the course of these last 3 to 5 months. Is now the time that we've done all of that research and all of that looking into it? Is it time to now pull the trigger? And I think that's probably played a big role with our investors at the start of this calendar year and sort of moving into the back end of the calendar year to say, okay, we've done the research, we've seen the data, we understand that it's a good time to sort of enter the market. Our cash flow and our employment has been stable. We feel comfortable, and people are really now starting to pull the trigger on some investment hopes that they may have had 2 years ago, but that sort of just put that on hold and started again to get that research going again, looking into that data, seeing if what they did a year or 2 years ago is now still relevant, because as we know, markets are cyclical. So I think understanding that and understanding the research and data has been really important. It's giving a lot of purchasers confidence to get back into the market, and we're seeing that now with the return with the return of a lot of investors sort of getting into the market in different areas across Australia.
Yeah.
Where maybe rental yields were not as great as what they were previously, but we're starting to see some stability and some growth in a lot of different areas, and people are starting to get their confidence back.
Yeah, absolutely. So I've got a little investor tip there to, sort of watch interest rate movements closely. Even small changes can significantly affect investor sentiment. And, we were talking off camera earlier, Zen, about the fact we're starting to see some of the lenders reduce their fixed rates. That's always a positive sign.
It's fantastic when we see things like that happening. It's generally a precursor to what they believe is going to happen in the market in the short and medium term. So we've seen ANZ drop their fixed rates. Macquarie, one of the big banks as well, also dropping their fixed rates. So I think signs are positive for those people looking to enter the market.
Yeah. It's a good segue into what are the big four banks' predictions for cash rate in the future. So all four of them believe that we have reached a peak of the cash rate at 4.35%. ANZ believes we'll see the first rate cut at 2025 and then drop to 3.6 by the end of 2025. Commonwealth Bank believes we'll actually see one by Christmas time, so let's all have our fingers crossed for that. And then they believe it'll drop to 3.1 by the end of 2025. NAB, first cut May 2025, dropping to 3.6%, and then Westpac, cut by February 2025, dropping to 3.1. So all positive signs that we have got some rate reductions in the future, and obviously we've seen some rate cuts in Canada, New Zealand, and the US, so hopefully we fall in line with those. So some other key trends that we're looking at in terms of major projects. Government and private sector investment in infrastructure like road, rail, public transport, schools and hospitals continue to support property demand. These are always important, but certainly in our second wind markets, they can help carry these markets well into another wave of growth. The impact of this is that we see infrastructure projects driving employment, making certain regions more attractive for both homeowners and investors. And markets near these major projects often benefit from long-term value appreciation. So not just looking at that short-term, flash in the pan hit of growth, but long-term averages. So we're really big at hotspotting at when we release our top 10 reports. That's always with a long-term plan, okay? Yes, we'd love to always see some short-term growth, but short-term growth is really just that. We all know that markets can have corrections, so you might get that big spurt of growth really quickly, but unless it's got all of this infrastructure behind it to carry it over the next 10 years, that capital growth could be short-lived. So on to government policies. So when we think about federal and state governments introducing policies aimed at stimulating housing supply and improving affordability, especially in undersupplied markets, they can have a big impact on these second wind markets. So policies such as tax incentives, grants or rezoning initiatives encourage new housing developments, which can boost supply in areas with tight markets. And then there's programs like the First Home Buyer Grant that can spur demand in second wind markets also, especially where affordability has been a key issue. And that brings us back to the regional markets again. This is where we're seeing a lot of first home owners that are, they're opting to go into these markets that are still well connected to regional cities. And I know some of the markets you're going to talk about today, Zen, they might be, second and third tier cities in each state. However, they're still connected very closely by infrastructure like road and rail. So it's important for a lot of first home buyers that they can still remain connected to family in the major cities. So, something that's been a big topic is our resilience. Throughout all this inflation, employment and economic growth has remained quite strong. Post-pandemic, Australia's employment rates have remained strong, with certain regions seeing higher than average job growth. The impact that has is job security boosts confidence. High employment rates foster consumer confidence, allowing more people to consider home ownership and investment. Markets near strong employment hubs like tech corridors or areas with booming industries like renewable energy may experience stronger second wind markets than others. So the next part is talking about how do we time these markets? How do we actually get in and take advantage of these second wind markets? Timing is critical to maximize your returns in these markets. Entering at the right moment can make a substantial difference to your long-term performance. So when do we enter? The best time to enter a second wind market is after it has experienced a correction or stabilization, but before significant capital growth begins. This is where our hot spotting price predicting index comes in. So for those who may not be familiar with our price predicting index, it's a formula that Terry Ryder's been doing since about 2012, where every quarter our team sit down and analyse every suburb in Australia, and we commit a ranking or a categorisation to every suburb. Is it rising? Is it falling? Is it recovering? Is it stagnant? And essentially what that is drawn from is sales volumes. We believe that the number of sales per quarter growing or declining is a bit of a precursor to price growth. So if we see rising sales activity, we often see prices increasing. If we see sales volume softening, we see prices soften. So the way that we see that is on these graphs here. So if we look at that and you see sales volumes per quarter, back in 2021 at its peak, we've slowly seen that sort of drop down. Obviously, we have had some effects of interest rate and probably not so much the sentiment with the interest rate rises, but the borrowing has had more of effects then. So where we come to to September 2023, we've started to see some increases in sales volumes in this market. Okay, this is just a generic one. We see this all over the country. So I haven't named the actual location here, but we will talk about them in a moment. And then as you can see, we've seen that strong growth that's happened here, and then we've flatlined. What we anticipate through seeing this rising sales activity is we expect this to occur. Okay, so in terms of talking about these next markets, we're going to hand over to Zen Christofi to talk about a couple of second wind markets. But before we do that, Zen, I know we touched on a little bit earlier, and you've been on the webinar with us many a time. But for any newcomers to this webinar, tell us a little bit about Reventon and the services you offer.
Fantastic. So thanks, Tim. Quite insightful, obviously, to go through a lot of that data, and seeing that, I'm sure, is going to be really helpful to our viewers. And I know using the data that you guys at Hotspotting have been providing has been very helpful for us and our sales team in looking for different locations across the country. But to talk a little bit about Reventon and our services, Tim, we've been operating for almost 20 years now. It's a family-run business. My brother, Chris Christofi, the CEO of the company, has been in the finance and property game for over 20 years alongside with myself. So collectively, we've helped over 5,000 investors get into the markets, and we've had a number of different changes through those 20 years of being in the market. And what we've put together now here at Reventon is a group of services to allow an investor to take a holistic approach from A to Z. And when it comes to looking at investments, we're able to facilitate looking at the areas to purchase in, sourcing loan products. So obviously real estate and buyers advocates here at our team at Reventon that have been doing a fantastic job since its inception. Our finance department, there's our team of mortgage brokers that assist our clients in their lending services, whether that's refinancing, whether it's looking at an equity release to help with investment purposes, or looking at investment loans, or even consolidating debts as well, Tim. Really having someone on your side, and myself personally been in the industry for over 20 years now, really having someone analyse your current financial situations, probably the most important thing. And to do that every 6 to 12 months, we find has been really helpful for our investors. It not only allows them to keep track of how their investments are tracking, but it also allows us to talk to them about new products on the market. And it also gives us an opportunity to talk to their lending institutions to see what we can do about sharpening rates and things like that, and especially in times like this.
Yeah, absolutely.
With rate rises and things like that. And it's great to see that the major banks and a lot of the major lenders are predicting that the Reserve will bring down the rates to between 3 to 3.5%. But at the moment, there was a lot of talk of doom and gloom globally when it comes to interest rates. But I think here in Australia, we've done really well in that sense. And there will be a correction in the market as there has been over the 20 years that I've been doing this. So we look forward to that into the market as well. So we also offer financial planning services as well. So we can help clients looking into different insurances, financial planning services for setting up self-managed super funds, to help with the purchase of residential property investment as well. So something that we do with our clients as well. We have accounting services as well, so we're able to help them with their tax savings based on their investments and things like that. as well as property management, so looking after the back end of the property. We all know, being in property for a long time, Tim, having a great property manager is probably one of the crucial things to the longevity of you being able to maintain that investment.
Yeah, especially with all the changes in legislation and everything now, you really need to be kept up to date with it all.
And I think with, especially with the buyer's advocacy arm, understanding that having a good property manager and dealing with a lot of different property managers across the country that have been looking after properties for a long period of time, you're able to get some fantastic information from those property managers to help you with your decision making, that then you can refer to your clients or your potential purchasers to talk to them about, okay, this is what's been going on with this property over the course of the last 2 or 3 years. This is the property management company that's been looking after it, and a real important tool for longevity in property investment, I believe, a good property manager. And last but not least, our client services department, and that really helps us facilitate and bring all of our services together, and especially with new build properties as well, keeping people informed on the progression of properties as well. As we know, councils can take some time to approve dwellings and things like that, and having someone sort of look at those time frames and really working with the builders and developers to streamline that and to allow that to be as quick as possible is really beneficial for investors in keeping down their costs through that construction period as well.
Yeah.
So there's some of the services that we offer here at Reventon. As I said, they're constantly evolving, and we really look forward to working with clients through all areas. And it doesn't necessarily mean that we will look after all facets. But in the event that someone's looking to have all things in-house, which is obviously preferable for our organisation, as we all work within the same office, it really just allows communication to be more seamless, and understanding that property investment involves a number of different people. So to sort of have all of those services in-house has been really beneficial for our clients going forward. But, that's a little bit about our organisation. Feel free to jump on our websites, our social media pages, to have a look at a bit more in depth about how we can help clients going forward. But I don't want to take too much time on that today, Tim. I know we are under the clock here, so I really want to talk to our clients about the things that lead to a recovery. And we're talking about second wind markets, and there's a number of different factors. And myself personally, been involved in real estate for a long time, and always trying to give myself a bit of an education on what are some of these things, and continually trying to improve in our decision-making processes. These are some of the key factors that I've found in my time in the industry, some things that lead to recovery. So firstly, when we're talking about in that sort of buyer's advocacy space, or even in a new land development space, vendor discounting is generally a huge sign of a recovering market, or a market that is about to see a second wind. Days on market, so short and long-term trends, is something that we look at. So we don't just look at what the trend has been in the past sort of 3 to 6 months. Let's look, go back and sort of look historically at what those trends have been. And as markets are starting to recover, we notice that those short-term trends start to change as well. Sales volumes, so the lift in listings. And I know, as we spoke previously, Tim, that can sometimes be seasonal, and understanding that generally in that spring season is where your majority of listings are going to come. But being in the industry for a long period of time, you can understand that they will also be consistent year on year when you talk about lift in listings. So if we're talking about the spring markets today, 2024, and the listings that are coming on, we can reflect back on the years previously and have a look at, okay, how are those sales volumes looking, and how are those lift in listings looking also. Yep. So rental yield, once we start seeing rental yield start to recover, and a couple of the markets that I'll speak of today, we are seeing those trends in rental yields starting to come back. Population growth, and we did touch on that at the start of the presentation, Tim, and generally in these recovering markets, especially when we're talking about regional areas, the into those regional areas that has great connectivity is another key driver to what lead to recovery. Stabilisation. So once we've seen a period of stabilisation, we understand that once there's some movement after that stabilisation, then we're generally coming to a period of recovery through that as well. And new employment opportunities, and that could be through the private sector or also government spending throughout an area. So those are the sorts of things that we look at. And obviously lower vacancy rates within a suburb as well. We've been very fortunate in Australia when it comes to property investing, understanding from the majority of major states as well, but really looking at those rates being sort of below that 2% mark. And as they're tightening, we can sort of see that these second wind markets are starting to make a recovery as well. So I've listed a few of the second wind markets here today. I'm not going to talk about all of those second wind markets, and the reason being, Tim, we've got a limited amount of time, and me and you could probably talk about these markets for a few days, I believe. But I have picked a couple of the markets. So obviously, Sunshine Coast in Queensland, we've seen that we are going to see a second wind there in Albury, New South Wales as well. Hervey Bay in Queensland, some areas where we had a lot of clients entering in sort of in that early 2020 period as well. Geelong, Victoria, and Bendigo, Victoria, which are a couple of the areas that I will touch on today, and give the viewers a bit of information to the reasons to why we are heavily looking into those regions as well. Ballarat in Victoria, Byron Bay in New South Wales, the Mornington Peninsula, Tim in Victoria, also one of our wins when it comes to second wind markets, in Canberra, the ACT, and specifically talking about the unit market. And I know a lot of people have been talking about growth with units not matching growth of house prices across the country, but there are specific markets across the country where units are outperforming houses. And again, understanding those areas and those locations is important when making investment decisions as well. So as I said previously, we're really going to touch on today the Geelong and Bendigo market. These are terrific examples of second wind markets, and they've been proven success in the past. And we believe the indicators are showing that they're now ready for their next wave of growth. So we've been out to those areas, having a look at different infrastructure spends in those areas and things like that, and obviously using different data sources that we rely on. You guys at Hotspotting have obviously been fantastic for the research that you've been able to supply for us in these sorts of second wind markets. And I'll talk a little bit about some of the spending that's going on in those regions and in those locations. And you can see that when there are significant spends, not just across the private sector, but also government spending, that these things are going to definitely help with the rise of properties as well. So Geelong has been designated regional growth centre, and it's expected to absorb overflow from Melbourne's population that we spoke about previously as well. So major infrastructure investments, over $14.5 billion in developments across the country. And I know a couple of years ago, Tim, when we were speaking about some different markets, and especially sort of looking into that Western Australia market 2 or 3 years ago, we were looking at how many government infrastructure projects were going on. And they were very similar sort of numbers there, with mid-hundreds with major infrastructure spend. Now we're looking at that sort of happen in a larger regional hub like Geelong. So 147 projects, including transport, health and correctional facilities. Obviously will attract growth to the area, but obviously attract employment in an area as well, which is really important when people are considering investing in locations as well. So $1 billion rail duplication between South Geelong and Warm Ponds, so helping to improve connectivity in that Geelong region. And also the Avalon Airport, which will become Victoria's largest seaport and rail and road terminal. So $1 billion infrastructure spend around the Avalon Airport area as well, which is huge government spending in there as well. So government and business support. We've seen the G21 Regional Growth Plan support long-term development with key projects like the freight hubs and various government alliances driving growth in the area. I think significant population growth projections. So these numbers here sort of really ring out to us here at Reventon. 500,000 people in 2047 to 1 million people in 2075 predicted population growth, supported by obviously a lot of greenfield developments and new housing projects in the area. But you can see that significant population growth there. And even with government and greenfield developments, if you look at those sorts of numbers for the local demographic to be able to put that many houses to house different investors, first home buyers throughout that area is going to be quite a mean feat, and that really plays on the sort of supply and demand concerns there. And as you can see, over the course of the next 25 years, there's significant population going into those areas, which leads us to believe that we're really going to see that second wind coming up now as well. And we'll go through a few things later talking about how that's affecting the area as well. So we did speak about the housing development. So the Armstrong Peak Master Plan Community, one of the largest housing developments in that area, that's expected to house 110,000 people by 2036. And also Geelong Framework Plan, $500 million spent in the South Geelong and Urban Design Framework, which will enable high density and residential development. So local governments are not only looking at different housing estates, Tim, they're also looking at different high density developments in an area. And that there is an indicator that there is a demand for a larger housing supply, and that it can bring high density development can house people probably a bit quicker than some of the larger land developments that they're able to accomplish as well. So that, again, another indicator to some great growth in that Geelong region as well. Big one here, Tim, the economic boost from defence contracts. And we've seen a lot of these things happen across the country in a lot of these areas, which people like to call hotspots. And $1 billion in the Armour Vehicle Centre at the Avalon Airport and $10 billion defence contracts, creating jobs for the local economy, is huge spend for the area. And again, as I said, really helping drive property prices as well. So residential expansion through the Armstrong Peak area, which we did touch on previously, Ocean Grove, Barwon Heads and Norlane, also large residential dwelling areas as well, and much needed housing for not only residents, but also commercial businesses in the area, and community infrastructure as well, which is going to be important to those areas. So we'll move on to the graph here. And Tim, we will offer listeners an opportunity to get our reports as well. So they can contact us at the end of the presentation. And if they're looking to book in a discovery session, we'd be more than happy to share some of that data and that information with our viewers today. But just over to the left here, if we're looking at the Geelong sales volumes and trends, and we spoke about property prices and sales volumes changing. And if we sort of look into that area, we see that back in 2021, we had sort of an upturn in December 2021, a little bit of a correction in September. December, it started to have a bit of an uplift, but then we saw some significant change as we head down to March in 2023, where we saw sales volumes start to drop and we saw correction in the market. And as we're looking forward and we move to sort of June 2024, we're seeing that we're now starting to see some stabilisation and some growth in those areas. And as you said previously, Tim, a huge indicator to property growth cycles is sales volumes, and looking at those volumes starting to change. And myself personally, as I said, being in the industry for a long period of time and understanding that there's a lot of different I suppose, property experts that are out there and talking about the different trends and why property prices start to change. In my experience, sales volume has been significant, and really looking at sales volume has been something that I've thought is probably one of the most important things to talk about price change. So happy to see what's going on with sales volumes here in Geelong at the moment as well.
And just on that subject, Zen, we've just started analysing the September results for our price predictor index, and I can confirm that our graph will be somewhere up here as of next month. So Geelong's sales volumes have continued to increase. So it's a promising sign, and I think you're on the money.
Yeah, fantastic. Thanks for that, Tim. Next area that we have a look at is another regional town here in Victoria, one of the regional growth centres, Bendigo. So Bendigo, alongside with Ballarat, one of the largest regional areas, and huge infrastructure spends in those areas as well. We're expected to contribute half of Victoria's regional growth in 2031. So the population forecast, again, we spoke about population growth, internal and external migration as well. So from 121,000, which was the census in 2021, to 200,000 by 2025. With that growth, there's obviously going to be driving demand for housing. So again, something to consider when looking at investments. Livability. So as most of our viewers would know, Victoria and Melbourne was ranked in one of the most livable cities, and Bendigo now also falls into that. The RMIT University in 2020, public transport, local employment and housing affordability is something that we've seen attract a lot of investors in that Bendigo area as well. So a sustainable industry base, so strong sectors. We did talk about a number of different sectors in an area as an indicator to rising growth and property prices. Health, education, government spending, and all have seen some significant spends in those areas as well, and which will perform quite well. Also performed very well during the pandemic, and it's offering stability and future growth for that region as well. Again, back to, I suppose, rail upgrades, $50 million in the Bendigo Metro 3 upgrade. That's improving connectivity with new stations in the Bendigo region. Gurulong, Huntley and Raywood, also 3 new stations opened up in the Bendigo region with more frequent services now as well, so every 20 minutes, so more connectivity into major cities as well. And the regional rail link, $5 billion spent, which will help connectivity between the Bendigo and Melbourne regions as well, which is fantastic for people looking sort of in that Bendigo region as well. Healthcare investments, so $600 million spent in healthcare investments. The Bendigo Hospital, one of the largest healthcare investments in regional Victoria, so boosting the amenities and obviously local employment in the area as well, and education and business expansion, so ongoing school upgrades, which our government's been assisting in the region, and also the RMIT and La Trobe University are expanding their operations in Bendigo, so that will obviously strengthen the city's educational appeal as well. So a lot of university students moving into those areas, a lot of people looking for temporary homes for those 3 or 4 years while they're going through their tertiary studies. Another huge factor to help drive prices in there as well. A $12 million upgrade to the Bendigo Airport as well, which will be completed in 2024, and that will enhance regional accessibility and include a new terminal and new flight training facilities in the region as well. Number of hotel developments throughout the CBD, so they're injecting $120 million into investment into that as well, and that's obviously going to increase tourism, help with the arts and event centres, and also something which is a significant spend in Bendigo was the Gov Hub as well. So $90 million spent on that. and that will bring 1,000 jobs into the public sector as well. So that will contribute $131 million to the local economy, making Bendigo a fantastic point of call for people when they're looking for investments as well.
Yeah, very good.
Again, as I spoke previously about the location reports, we also have location reports available for the Bendigo market, which we'll be happy to share with our viewers. If they want to get in contact with us, we can arrange a discovery session. We can go through that as well. Back to the sales volume trend, Tim, and as you can see here, very similar to what we spoke about with the Geelong region. We are seeing a very similar sort of spike there, and I'm pretty sure that if you looked at the updated sales volumes in Bendigo, we would see that the trend in March from sort of December to June and heading to the back end of this year as well, we're continuing to see those sales volumes increasing as well, which is good signs for investors in that marketplace as well.
Very good. Thank you very much, Zen. I know we only had time for a couple of locations today, and both happen to be in Victoria. But you know, obviously you've got some other locations that you can speak to your guests about if they do reach out and book a meeting with you. I will put that up on screen so that people can have a chat and book in a meeting with you whilst we answer some questions. The first one that we've got is from Tony DeRosa. Tony says he's been an investor in Gladstone with multiple properties since 2002. He's seen the local market lagging well behind similar coastal cities, even though they've seen some significant growth in the last 12 months, sort of 15, 20%, mostly off the back of the affordability factor and coming from a lower base. Given there's little local talk or understanding of the imminent green infrastructure projects to come to underpin long-term growth, I feel we're in a position for major second wind market next year. Tony, I mean, for me, I would say, you know, if you have a look at what infrastructure is likely to come, there is very good chance that you'll see the inland rail make its way up to Gladstone, which would be very beneficial. I certainly think that will give you a very strong second wind. But also, you know, we've seen rising sales activity and other factors like days on market reducing and things in Gladstone. So I think there's every chance that you would see another second wind there next year as of course the interest rates come down and make borrowing capacities more affordable again too. Next one was anonymous attendee, but says Vic land tax is a killer. I would tend to agree with you there. Look, it's one of those things. Victoria has higher stamp duty than some other states. We definitely have a higher land tax here as well. Whereas, you know, as an example, you cross the border into New South Wales, you don't have a land tax threshold until $1 million, whereas it kicks in at 50,000 here. So I feel your pain. But what I would say is in any investment that you look at, there is a pay to play, right? So some of these locations that you look at up north that are showing, you know, terrific price point opportunity and maybe terrific rental yields, you do always have to not only look at the gross yield, but also the net effect of that and also your cost to get in and out. So I think, you know, land tax it's something that if you want to own investment in Victoria and take advantage of us being at a lower point in the market, it is something you've got to consider and not just consider it for year 1, 2, or 3, but well beyond that as well. So it is something you need to consider with any investment. Think about the long-term costs. But I would say, you know, if you can buy real estate here today well below market value at the bottom of a cycle, then there's every chance that it could be well worth paying the land tax in the long run. He's also asking if there's any locations in Queensland that are under 500,000 that we believe would see a second wind. I don't know if you've got anything that you'd like to add to that, Zen. I'll quickly put my 2 bob in and then throw it to you. So for me, you know, 500K for a housing market in Queensland in any significant location, you know, a population of 15,000 or more is quite difficult unless you're willing to, you know, buy a rundown property and do it up. But what I would say, and we've touched on this many a times in recent times at Hot Spotting, is that we're seeing these markets all over the country where units are outperforming houses. And I don't mean go and buy a high-rise apartment necessarily, but a unit might be a standalone property that's maybe on a smaller land component and breaks into that 500K and below market. So there's a lot of markets that we can see that are second wind in Queensland, but at that 500K mark, you might need to consider unit. And I would suggest that it's something that people should open their eyes to because the results are there. We can't shy away from the fact that units are outperforming houses all over the country now, Zen.
Yeah, and I think that's been a significant change, something that in my time we haven't really seen. We haven't really seen that happen. It has been in some specific areas, but when you've got a median house price in Queensland over $800,000, trying to find a dwelling at that sort of $500,000 mark, you need to make some form of compromise, and that may be the land components in that area as well. And I think obviously what you said previously, Tim, is important for investors to think about that. If you're looking to buy something with a larger land component, that dwelling may have been there for a significant amount of time and may need some consistent work. So really having an understanding of the areas, the property managers, sort of building those relationships with people before you make those investments is key. And I think understanding that people specialise in an industry and specialise in an area for a reason, and sometimes trying to get that information from some of those people would be very helpful before sort of making your decisions. And once you think that it's going to be something that's going to be beneficial for you and your family, then obviously the decision then lies with you. But I think investment's always a long-term play. And you may have your look at it over a long period of time, over a 10-year period, and you may have your 2 or 3 years throughout that period where you didn't see the growth that you were hoping to see. But if you look at it over a long period of time and it's performed significantly better than the average property prices across the country or the median growth price, then you've picked a winner. So diversification is also important. So looking where your portfolio is and being able to diversify, I'd say is really important. But a lot of people are really quick to jump out of an area for a specific amount of time. And in my time in the industry, I've seen that happen a number of times. When someone was holding on to something for that period. And we spoke about it at the start of the session, Tim. How long is that property going to stay at the bottom of the market for? So you might buy at that bottom of the market, not seeing too much sales activity, and you were thinking, okay, well, this is maybe a 1 or 2 year hold here before we start to see correction. But that 1 or 2 years can quite easily turn to 4 or 5 and then see some massive correction after that sort of 4 or 5. So really understanding you make those decisions going forward as well.
Yeah, very good. So Zen, we have another question here. It says, what strategy is specifically for you, Zen? What strategies have you found to be the most effective for investors with a smaller deposit? It's a great question.
Yeah, and I think, again, Tim, really understanding your financial situation. So talking to a mortgage broker, I would recommend you sit down, speak with a mortgage broker, discuss your plans, discuss where you're at today, when you're looking to purchase, what the goal is during that period and things like that. But if you have a smaller deposit, you might want to consider constructing. And the reason being, you'll save some.
I think we lost you for
about today, where there's a second wind. You can see some growth through that period whilst your home's being constructed. And we've seen a lot of that in the past 24 months here at Reventon, where people were purchasing in an area, they were waiting a bit of time before the land was actually handed over or titled. So they sort of land bank for a specific period of time and seen some significant growth. Once we saw the market starting to turn, we saw those land prices starting to increase as well. So people were not only seeing an increase in their land prices, by the time their property was constructed, as we know, building costs have changed with new regulations coming through as well. But they saw some significant uplift in the land, which has allowed them to then use that equity and sort of go again, sort of reassess that. But smaller deposit, you may consider a number of different things. You may talk about, as we said previously, maybe looking at a unit. But if you're looking to construct and save on some stamp duties, and you feel that you're comfortable through that process of construction, you feel comfortable with your employment, definitely consider something like that as well.
Very good. Next question we had, with a lot of investors selling up in Victoria, do you see this as an opportunity or a risk?
That's a great question, Tim. We often get asked that here. And I think, obviously, fewer rental properties in a market is what helps push rental prices up. So we, again, sort of touching back on what we did speak about through that and the property clock, when we talk about less competition within the market. Again, so myself personally, I always like to look at it as the glass half full approach and understand that investment, we're talking about long-term investment here. And if I'm going into a market that is really hot and competitive, there may be some benefits to that, but going into a market where I'm able to have some negotiating power, there's a bit more stock available in that price point, again, can be beneficial for people as well. So really, again, looking at the diversification and a number of different things. But myself personally, fewer rental properties in an area means that rental price is going to push up, which means your holding costs are lighter, and again, allow you to sort of duplicate at a faster rate.
Yes, I'd agree. And I think, if you were to ask Warren Buffett the same question about Victoria now, he'd probably say be fearful when others are greedy and greedy when others are fearful. Okay, so we've got a couple of questions here, which I can pretty much answer very quickly because they're asking, can we get these reports that are being shown on the slide? Yes, you can. Please reach out to Zen. I'll put the QR code back up again. And if you want a copy of those reports, Zen will be more than happy to share them with you. We also had a question, how to check the rising sales volumes, which tool do you use? So all of that data that you're seeing is part of the Hotspotting members portal. So jump on our website and have a look there. We do have some deals at the moment on our memberships. You can get a membership for $299 a year. At the moment, there's a $250 credit for a report, which you can use at any time. So that's where you will see all the rising sales activity and our price predictor index. So you can search any suburb in Australia and check its ranking. How do we verify the infrastructure projects mentioned in the report? We've got a team of report writers that don't just rely on what they see on our website. We have old-fashioned journalism where we have a look at an infrastructure project. We actually call up and say, where is it at? So there's a lot of actual, follow-up that we have to do in order to make sure that the information within these reports is accurate. That's where you get that. Another question that we had is, where does the Albury-Wodonga region fit into the conversation on second wind markets, or is it just considered an ongoing market? That's a good question. I can tell you now, my most recent investment that my wife and I did was in Albury, and you could ask the question, why Albury and not Wodonga? And it comes back to that point. Stamp duty, if I buy something for $550,000 in Wodonga, it'll cost me about $35,000 in stamp duty. I cross the border into Albury, it'll drop by $10,000. My land tax kicks in at $50,000 in Victoria, but it is $1 million threshold in New South Wales. Now, I'm certainly not wanting to put people off Victoria, but you do need to consider these factors on any investment. Albury and Albury-Wodonga, the Twin City border town, is considered a rising market. It is something that we really like because it's a diverse local economy. It's it's got defence, it's got ATO, it's got Woolworths distribution, it's got the inland rail. Lots of really positive stories. So that's where we would put that, and it's definitely considered a second wind market. It has had a big jump after COVID, and then it had a flattening out, but we're seeing lots of rising sales activity there now.
And I think, Tim, just to touch on that as well, it's something that you would have obviously considered when looking at that was diversification for yourself. And knowing that you've been a property investor for a long time now, and something that you thought, this is what's going to be best suited for my family, and that's what you did there. And we've been working in that Wodonga market now for quite some time as well, and we're seeing rising prices in that Wodonga market as well. So depending on someone's circumstances and situation, if they were looking at an established purchase, they may have been looking at the Albury market as a win. If someone is, say, interstate and looking at investing into the Victorian market, they might look at new construction areas that are going on in that Albury and Wodonga area as well. So I think really highlights the point of what we've been speaking about today, is understanding that you have to have some goals and objectives with your own portfolio, and assessing that with people that have the knowledge, that are on the ground, seeing about different rising locations and the reasons to why they've come up with that. And you highlighted yourself that journalism getting on the phone, speaking to people, finding out how those infrastructure projects are coming along is another way to just reinforce some of the information that may be put on a lot of these websites and things like that. And something that we do here at Reventon is when we're looking at locations, and obviously we've got assistance of the team at Hotspotting and looking at different locations in areas. But we not only rely on that assistance from the data and the information that we get our sales team out on the road. We go and talk to local retailers. We talk to local councils. We do a number of different things to make sure that if we are putting a number of investors into those markets, there's reasons why we're doing that.
Yeah, absolutely. You can't beat boots on the ground.
Absolutely.
All right, Zen, we have reached that time, 2:00. We're already starting to run over, so we're going to have to wrap things up. But I really appreciate your time and obviously helping share some really good insights on some of these second wind markets. I do urge anybody that would like a copy of those reports from Zen, please reach out to him at zen@reventon.com.au, or you can book a meeting there using the QR code. From me, if there's any questions anybody had in relation to the data or would like any more copies of sales volumes, please feel free to reach out to me as well, tim@hotspotting.com.au. Great to see everybody. Look forward to seeing everybody again. Zen, let's do it again soon.
Thanks for your time, Tim. We really appreciate you taking some time out for us today. And thank you to the viewers. And we hope you found today's information insightful.
Good man. Thank you all.